So what we're going to do now is flip over to the bank reports. And I just want to walk through. We'll just scan through these. Now what I've done is I've placed these examples of bank reports in your books. And the reason I did that is so that you can, there's the first one there is an HSBC, just a weekly overview that they would send out to their FX departments and maybe some of the other arms. Each of these banks, of course, they have large research teams, and the research teams drive up or accumulate hordes of information on the fundamental aspects of the global markets as well as the technical aspects, and they bring in all of this data that supports one side or the other. And that weekly report that you see in there is a little bit overboard. Okay, it's a little bit overwhelming or overboard. So what I'll do is I'll just pick out some of the basic undertones of what they're thinking. So for example, in this report, we had a situation where the Canadian dollar was moving into a strong rally against the crosses, and in this case it just gives you a bit of an overview of what's happening in the Canadian dollar and then other aspects of FX. Interestingly enough, I was long the Canadian dollar before any of the banks were. And against the crosses, and then when the bank started to support it, then I was getting much more comfortable about the positions. But so first of all, if you just go through the weekly and then flip on to the next one, just flip through those HSBC reports. But if you'll have a look up here on the screen, I'll just kind of point out some of the things. So for example, if we go to Market Focus, where it says Market Focus, the jury's still out. Canadian dollar, the jury's still out but looking innocent. Okay? You know, they don't know what's going on with the Canadian dollar any more than you or I do. They have all these, research reports and information, but they are still, there's no holy grail in the bank either. They're still a little uncertain as to which way flows are going to take that currency based on the fundamental foundation. Okay?
Are the people who generate these bank reports people that are involved in buying and selling of the currency?
That's a really good point. Number one, keyword being people. Okay? Now think about people. These are people who are part of research teams. They come to the bank, they ask for a job, they have qualifications, they receive a job, they have a role. Okay, their role is to look for certain aspects of the markets and do analysis, and then they summarize it, and then they give it to the next person. The next person puts it into a nicer, bigger summary, maybe adds, edits, and so forth. Then that person sends the information over to the trading desk, and the trading desk reads it. Right? So the person who does the initial compiling of the information, naturally there's a certain degree of accountability and credibility that has to be that is at stake when compiling the information. However, there's no real connection between the information that there's not a real consequence for the person compiling the information in relation to the person that's actually going to use the information to decide how to interact with the market as a trader. So you understand how the whole, because this person, I mean, they're looking at their clock, what time's lunch, maybe they went out, we don't know. They're human beings, right? So we have to take into account that there is a chain of human beings that the information passes through before it ultimately ends up in the hands of the trader. Then the trader has to discern the information, decipher, sift, what's relevant, what's not. They have to filter the information, okay? And then they decide whether or not they believe it to be pertinent. It's that independent thinking aspect, right? So I take into consideration all of these aspects that sometimes this person, maybe they had a bad day. I'll with an overview, I'm like, you know what? I have no interest in doing what they're thinking of doing, or, maybe in one, you'll see in some of these reports, people are sometimes making, speculating on calls. maybe because they're expected to, and right? So these things have to be considered. It's what I call your filter. You have to use your filter and that independent thinking aspect of trading. And the reason why I say this is I'm not saying this just pertaining to this specifically, but to you as a trader with whatever market it is that you're trading, you need to use a filter. Okay. Worry?
My concern is, why should the bank have to hire people, pay them lots of money, write this information, and give it to us?
The bank, they have research teams. They need research teams, right? Economists and research teams. So they compile information. They're just trying to create an efficient process to give the trader information, because the trader needs to get their information from somewhere,
Yes.
right?
Why would they publish it? Why would they give it? Why would we be able to get it? Why?
Because most of them are clients. So if SSBC publishes that, it publishes for the client.
Yeah, so what they do is they publish research. So if you're a client at a private bank, you can ask the FX department, you can say, can I receive your research reports, your daily research reports for Asia, Europe, North America, or they have all different aspects. There's so much information, you need to decide which ones you use, but you can request it. So, and the reason why they need to provide this for their clients is to provide a good service so the client stays with them and keeps flowing money through them so that they can continue to trade and to distinguish themselves from other banks. Say, well, I like this bank's reports better than this bank's reports. I find the FX environment with this bank more efficient, more friendly, whatever, more informational. So that's why they'll create these kind of reports and offer them to their clients. And the FX departments will be, sometimes there may be little internal quirky things that come up last minute that they can't get out to the client that they might send internally, but that's a little bit different. Okay?
Are they trying to, the people who put out these bank reports, are they trying to create beneficial information for their clients, or are they trying to create a bias in the market that will be an advantage to the people who are publishing the bank reports?
It's kind of a loaded question, but which is a good question. Loaded questions are good, especially when they're pointed at the bank. Okay, so the banks will create these reports sometimes with clients. We especially see this in Singapore. Okay, in Singapore, they'll publish information. They'll release it to the client, and it will inspire an interest in a potential position. Now, if the client takes a position, the bank makes money on the transaction. It's very difficult for the bank to, through solicitation, to generate enough volume to create any kind of move in the FX market. That's typically done by if that's going to happen, it may be through intervention or some large entity during an illiquid time. But the banks, they do it for research and informational purposes, but also there are certain items that will come out that will maybe inspire a transaction by a client, which can help generate commissions. Okay? It's a little bit more, it's not quite to the degree that a bank comes out with a product offering which can make no sense whatsoever and not be of benefit to the client whatsoever, and I'm amazed at some of the stuff that I see. They can come out with a product offering that's going to serve nobody good but the bank. It's going to generate them a lot of money based on fees, commissions, and the whole structure can make no sense. But people don't know. They're like, hey, you're the bank, you're authorities. If you're telling me to do it, I'll do it. I don't know that much about the industry. Say, if you think it's good, I think it's good. Sure, I'll commit to that for 6 years. And then you realize 2 years in that it's not what they originally said it was. So it's not, it's not quite like that, but you get the idea. But it's a very good question. So as we continue through here, there's also other good informational aspects that give you the feel of the undertone of what's going on in the global markets. Now, I want to tell you where this is going so that you don't start thinking, boy, this sounds like a lot of work. Because I will give you resource sites where you can get basically a summary that'll take you 5 to 10 minutes to read on a daily basis that will totally keep you in touch with the FX markets. Take 5-10 minutes, read it, boom, it's done. It gets emailed to you every day for free. Okay? But I'm just trying to take you into the depths so you understand the animal. Right? Those of you who have pets, you understand how it responds to certain things and how it behaves, and you see the patterns, because that's what trading is. We're recognizing patterns and characteristics and behaviors, and we're trying to take advantage of it. You know how your spouse and your kids react to certain things and stimuli and aspects and challenges, and when they're being pressured, they respond differently. Well, that's what we're trying to do with the whole marketplace. Right? So I want you to understand how this thing, thinks and breathes, so that you can use this as a foundation to making wise decisions and help you to become an independent thinker. Does that make sense? And that doesn't only just apply to this. Whatever market it is you're trading, or whatever beast it is you're trying to extract money from, right? So we'll just get through this HSBC, but there's a couple little quirky things that I should point out, just so that you have a feel for, this is COT data right here. You guys are familiar with futures COT data? They just give a bit of a summary. They show, nothing different than what you can access online. So here's one from Deutsche Bank, and they just send out, those send out a one-page overview. And if you read through this overview, all it is just an overview of, what's gone on fundamentally, what we can expect. Maybe we think it's going up, maybe it's going down, and so forth. And so read through it just so you can get a bit of a pulse to understand the animal. Now over here they've got this, Euro USD visualizer. They have a dark line which indicates where current price is, and above it they have levels of resistance, and below it they have levels of support. Okay? It's not rocket science. It's resistance and support. And they're looking at those levels. And you know what they'll tell you? They'll tell you that if price moves above 34.10, then we're targeting 34.65. If it moves above 34.65 and holds, then we're bullish. Okay? If price moves below 3,300, then we're bearish. Okay? It's no magic formula. Because if you're one bank, there's a multitude of very large private banks with enormous amounts of money flowing through. And they don't know what the next bank is going to do. Some of them, they talk to each other a little bit. But generally, they focus on their own book. Even the smaller ones, they'll just focus on their own book. Okay? So here they have a market bias index. Okay? They think one's going up and another is going down. It's just, that's how they feel about what's going to happen the next day. So continuing on, they have just sort of a general directional bias here, where we think that, based on our understanding of the market, we think that one's going down, one's going up, the others are going to continue sideways. And then this company here actually projects how they think price is going to move in the future with this little red line. Interesting aspect on this one that I want to point out is this one is the Scotia Bank, and I was supposed to have white out that piece there, which I think on yours probably is, because we don't need people emailing the bank research team. There's other places you can get these reports. So now what's interesting is this. They do their analysis, the research team does their analysis, and then they offer it to their trading team. And this one here, again, the time that I had pulled these reports out and put them in the manual, there was a strong Canadian dollar sentiment at the time. It was starting to turn very, very bullish. And one of the contributors is interest rates. So for example, when I talked about, you remember I talked about how the US dollar had been falling through 2004, then January 1, 2005, the market said, this is the year of interest rate hikes, let's start flowing funds into US dollars. Okay? Right here, there's a little note right here. It says, okay, Dollar Canada has slowly moved higher the last 2 days as the market reassesses its initial interpretation of the FOMC statement. Okay? FOMC statement comes out, traders adjust their positions. Originally taken as US dollar negative, the market seems to have repriced the level of concern over inflation and is hence unwilling to push the US dollar lower. So the market says, okay, we think inflation is going to soften, therefore there may be a hold on rates, therefore we're not interested in buying US dollars, so they slow down, so the US dollar trends flatten out or maybe reverse. Okay? Now this is what I want to point out right here. Fed fund futures initially priced in 2 Fed cuts in 2007, but now have scaled this back. The Fed fund futures, some of you may watch that. Any of you watch that or trade that? The Fed fund futures is usually one of the first to price in an interest rate related trend with currencies. Okay? In this case, the US dollar. So for example, when the trend shifted in 2005, Fed fund futures had already been pricing it in November, December. So if you're sniffing Fed fund futures, and the rest of the world is looking the other way, you know, when the one side of the market is all doing one thing, get ready to start doing the other as soon as you get a sniff, and look for the confirmations and the reversals. And they're not all convinced yet, but you're in at the base of the reversal, and start to look for that. So it's the so there they talk about Fed fund futures, and then there's other aspects, you know, home sales, and here we talk about Canadian dollar futures, but not too much you're not already familiar with. Okay. I'm kind of going a little bit on the understanding that a lot of you are you know, pretty experienced in trading, and you can sort of see how this works a little bit from the fundamental aspect, because if you're trading futures and equities, you have some understanding of some of the fundamental aspects. Like, are we doing okay? This is just this phase. We're going to move into the technical phase right once we plow through this. Okay? Pardon me?
In the actuality, that assessment didn't turn out to be the case, did it?
No, it didn't. No.
It's also worth, I think, noting that in this case, there may be some hedging going on, where the futures are priced as a hedge vehicle, right?
Mm-hmm. Yep, correct.
Which is the driving force, the FX or the equities or interest rates?
The driving force of what specific of what?
Which one's changing? Well, like the equities, where we started out, where Shanghai dropped 10%.
Which one comes first?
Yeah, is the
They take turns. It depends on the events, how the events are unfolding at the time, right? Like the next unwind in FX probably won't be exactly what happened with the Shanghai situation. It'll be something else can trigger it, and it doesn't have to be anything of any substance. You know, so in terms of looking for a specific trigger, the more you understand the market, the more you'll be able to pick up on the trigger, whatever it is that comes out at the time. You know, just like in equities markets, when major corrections are triggered, it's usually just a lot of just inconsequential aspects that unfold in the market and almost is used as an excuse for the markets to correct, right? You know, with technicals, and you're going to see a whole presentation of them, but in technicals we can say, oh, look at that beautiful chart. You know, it bounced here and then it bounced there and then it moved that way. It's so technically just beautifully laid out after the fact, right? I mean, unfortunately, that's the only way we can present theory and concepts. That's what we're, you know, that's the way to initially get a message across. But fundamentalists do the exact same thing. every day after price action, like let's say in the FX markets, fundamentalists will say, well, yeah, of course it went from here to here because boom, 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 and they get into a lot of details on the fundamental drivers of what caused the currency to move from A to B. It's after the fact fundamentals, right? They do the exact same thing, and you can combine the two. So don't think that I'm naive or trying to be, deceptive in terms of, I understand the realities of the layout of dealing in the financial market. So we have to be able to filter that information. By filtering that information comes from independent thinking and understanding your market. And heck, if Alexander Elder said it, it's worth repeating. I've never read one of his books, by the way. I've only ever read Trading in the Zone, First Market Wizards, and then I've scrambled through like bits and pieces of other books, and that's all I've read on trading. What I'm saying is there's hope. Everybody thinks differently, and it's...
And then what I hear you saying here is that the currency markets are highly subject to fundamental changes, and that there are many different ways of obtaining this fundamental information, and you're showing us different aspects
Yes.
and different publications that do that.
Yes. What I want to do is lay a foundation so that when you see different forms of approaching the market, you're able to interpret the information from a more thorough understanding of how the overall market works. Because, to be honest with you, with foreign exchange, there's so much crap out there now that I'm almost embarrassed to say that I trade FX. In fact, I don't say it so much, I just say I'm in the financial business. Because there are people selling you things in ebooks and this and that, and it's kind of disturbing. And what happens is in the industry of trading, you don't know what you don't know, and what you don't know is harmful to you, but also what you don't know is profit to you. People will say, "Oh, trend lines. I already know all about that. I don't need to, I don't need to learn about that." Or, Fibonacci, or this, head and shoulders reversals. I already know all about head and shoulders. I don't need to learn that, So, and then they maybe go on a on a fixed approach to head and shoulders, and then maybe they lose all the time. And so it's we're trying to just broaden your spectrum of it so that you can make wiser decisions, filter the information, become an independent thinker. Then we'll start to zoom in on some of the more specific aspects, because there are scores of nuances about the FX market that are going to be ideal in helping you to ultimately make good decisions. Okay? But one of the objectives I want to achieve here is to show you the opportunities that exist in FX. From a portfolio perspective, if you don't like staying up till the wee hours of the night till your eyes are fried, then there are other opportunities that you can take advantage of in the market. Okay? So here's an example of CIBC. Now I want to take you down through, and then there's another one here of Commerce Bank with a Z out of Germany. I want to take you down, though, to these blue ones. You've got these blue ones, and the title is cut off. They're kind of cut off because I didn't want to. At the time, I couldn't figure out how to block it out because it's in PDF. Block out the who it comes from and so forth. But what I want to show you is this. Have you got this page up? Yeah. Okay. There you are. Don. Yeah. You got this page? I just want to show you this. That let me just magnify it a bit. Okay. So this is, for example, this is a report that a trader will receive on their desk. And what it does is it gives a summary of what happened overnight while they were sleeping. Just bullet point summary. Some of it's relevant, some of it's totally irrelevant, but just maybe a couple of the bullet points can help you understand. Just give you a feel for what the market's doing. Like in Australia, conference board indicator fell by minus 0.2 versus the last, and so forth. Some of this is very relevant, some of it's not. For example, here it says, Cullen says New Zealand dollar is stubbornly high, which means, oh no, Cullen's concerned about the currency rate. We better maybe shy off of buying New Zealand dollars, and maybe you see a little jiggle back in the currency dollar as a result of the comment. That one there comes from a private bank, so this one specifically you have to be a client at the bank, but the other ones, I haven't found where you can get this one available to the general public, but the other ones are all available to the general public. I'll give you a website you can go to get these bank reports that are updated regularly. I'll give you three sites to go to. Okay? But I just want to give you an idea as to what's flowing through the desk of the traders. It tells you the data events that are coming up today, and it'll tell you which ones are important, which ones are not. Currencies you're not trading, you can just even ignore those. Who's speaking today? And it'll tell you the majors watch, so the major currencies, talk about Canadian dollar. And then they talk about technicals down here. Oversold, overbought. And possibly we're leading in the corrective phase. So we're not really thinking unlike how you're thinking. Here they just have a technical focus where they have just drawn levels of support and resistance on the currency pair, which would not be unlike ones that you would draw that are visible on a chart. Okay? We'll just plow through this, and then we'll take a break and get into the other stuff. Now, what I wanted to show you is these technicals. For example, this is a Euro-US dollar. They'll send out, here's the technical view of the Euro-US dollar. This is a daily chart. It's a candlestick pattern with an up channel and then more parabolic up channel inside the up channel. Okay? It's not rocket science. They're just getting a general overview of what the technicals look like on this currency pair. Now, what they're doing is they're saying that there's potentially a corrective decline happening, but there's one pattern that I want you to see with the next few reports. One distinct pattern that's going to carry forward into what we teach in the technicals. Trading strategy: sell at 33.50. Price is currently down around between 3,300 and 3,335. Sell at 33.50. Is that above or below current price? It's above. Okay, it's above. So the selling, when the market gets going and the market rallies, they intend on potentially selling. But you know what? Whether the traders actually do this exact is highly unlikely. It's just a general tone depending on what unfolds as price action starts to pick up. Okay? But the pattern is that selling above the market. If we scroll down to the next one, the British pound, they got some Fibonacci levels in there, and an up channel and a level of resistance lined out. Okay? Fibonacci levels, a channel, and support resistance. That's what they're looking at. And you want to know, you know what? The dealers, that's what the dealers are looking at. Because I sat there and I watched in the bank. The dealers are looking at these levels. Some Fibonacci on the daily chart, some channel and resistance.
And the support and resistance levels on the left, are those pivot points?
Here.
R1, R2, R3?
No, that's just support and resistance, just standard. Those are actual numbers based off of price. These levels here. An actual price point. Okay? Now, sell at 96.75. Okay? 96.75, price is currently above 9,600, or it's currently at around 9,600. So they're selling above the market. Based on the way that I trade, this is extremely important. I really like Mark stuff where if you're looking to sell and the market's in a downtrend and the market rallies to a specific level of resistance and starts to turn, I really like the CCI and all of Mark's concepts around that as well. I think they merge in very, very nicely with this stuff. Okay? So here they're looking at, they got some Fibonacci levels in here, and some channel. They're looking at buying, and they want to buy at 67.60, which is below where current price is. So they're buying below the market. Here we've got an uptrend line that's been broken, some Fibonacci levels, and they've got an RSI, smooth RSI 9. That's it. This is kind of a semi-internal report, semi-internal, semi for some clients kind of thing. Okay? And I just want you to read through that and just get a feel for the information that they receive, then they go out and still make independent decisions. Okay? How we doing?
I find it hard to believe that $1 trillion bank flowing trillions of yens and euros and whatever is using something this basic.
Yeah, it's they, you know, it's not so much their own money. They have proprietary traders that trade their own money, that trade the bank's money, but it's mostly clients' funds. And a lot of the clients, you'd be amazed. In Singapore, for example, there's a lot of dumb money in the banks there because a lot of, you know, they have a lot of money coming in from Indonesia, and a lot of it's, you know, money that's acquired through questionable means and so forth. And a lot of people, they just don't understand FX. They just don't. I'm doing a lot of work there now, and because there's just so much misinformation in FX there that there's just a lot of opportunities there, and they just don't know what to do. Yet they want that fast cash because a lot of people didn't work to earn it. They acquired it through some questionable means and so forth. Some of them did. They built substantial businesses and so forth. But they don't know. And now with the global markets and the global exposure, and where they can move funds and invest it here or there, they need to understand FX more, and they see a lot of opportunities. So they just flow millions of dollars in dumb money flow through there. Amazing. Okay? So let's take our first break, and we'll try and make it quick if we can. Hopefully you're still done.
Understanding the basic fundamentals and concepts of the Forex market.
Oh, where do we go? Is there, maybe I didn't put a, there's a couple of websites. What I'll do is there's a couple of websites you can go to. One is saxobank.com. Saxo Bank is a broker. I have no affiliation. They're a broker. If you go to Analysis, Technicals, then it'll have a list of bank reports that you can access. But you're going to have to be like a member. You go in there, you sign up for a free membership, and then you can go in there and access the bank reports. Okay? And actually, that's where I got a lot of these reports. There's also forex.ch, which is Switzerland, as you know. You can go in there and you can get on an email list to receive bank reports daily, or you can go to their website daily and get bank reports. Or there's
Forex.ch?
yes. Or there's forexnews.com, and what Forex News will do is Forex News will send you a summary. So you don't have to sift through a bank report, but it'll be a summary that will take 5 to 10 minutes to read. There's a couple folks here have been to one of my classes before or have my CD package, and maybe they can share with you some of their experiences with this kind of information. Okay. I don't have any affiliation with any of these entities, by the way. So you can just go in there and sign up. It's free. Free is good. Resistance becomes support. Support becomes resistance. Probably a concept that you're all familiar with already. And now I just want to do is I want to bring it and I want to translate it. I want to create a connection between what you just saw with the bank reports and what happens on the dealing desks. Okay? We're all pretty familiar with this, I think. Is there anybody who wants clarification on this aspect? Price moves through resistance and then it becomes support at a future date and so forth. Now let's have a look. Let's get into some of the... now we're going to start to talk about some of the nuances about the FX market and price action, short-term price action in the FX market. And the reason why this is important is because when you're making intraday trades or engaging in intraday trades, this is going to help you manage current positions that you're in by understanding this aspect. Not only manage positions that you're currently in, but also figure out where you're going to place move stops to, and take profit. Okay. Now, this is 0-100 hours GMT right here, so the start of the day, and then we end the day over here. Start of the day and the end of the day. Price falls, makes a low, and then consolidates into the next day. Now, I'm going to spend some time on this slide. As the order flow, when a dealer sits at their desk at work, when the market is quiet, let's say they arrive at work during quieter market hours, before the flows start coming through and the orders start coming in and clients start calling, as the clients start calling, they'll have like an order book for the day. So they may have to fulfill certain orders for clients, or the clients may have specific prices that they want their orders filled. So they'll have, the levels will start building up on either side of the market. Some of these levels may have been there for a while. Some of them may just be new accumulated order levels above the market and below the market. Okay? And so they'll see that and they'll get an idea as to what sort of volume is imminent at different price points. They have no idea which direction the market can take, but they'll just say, looks like there's a lot of sell orders on this day or a lot of buy orders in this pair on the day. So now, here we have price slips through, and then we just consolidate. The market consolidates right here. This is, by the way, this is a 15-minute chart. Okay? I use candlestick charts because I just find them visually friendly, a little easy on my eyes. Price consolidates, and then this is when the Frankfurt desk typically opens up in or around this time. So what do we see happening when the Frankfurt desk opens? We start to see some movement. Okay? Then Frankfurt opens, and then about an hour later London opens, but they typically arrive at work around the same time. To obviously to be available for the demand. Price comes right back up to this dealing level, which was support, is now resistance. And the reason why is because that's a fixed number. It's a fixed number at the dealing desks. It is because as the orders come in, they're quoting prices to clients. They're quoting levels and prices to clients. And certain levels are more fixed or more routine levels to the dealers. Once a level of support has been broken on the dealing rate support, then that becomes the next high side on the quote in the quote range. Okay. So what we're doing right now is have you seen the Karate Kid? Wax on, wax off. Why the hell am I doing this? Okay, it'll all make sense as we move forward. Okay? Just stick with me through a little wax on, wax off. And we'll start bringing the pieces together. But we don't want you to forget this, because this is the most important. So the volatility picks up. They use this level of support as resistance. and they deal off that level. And the market, tries pushing through a couple times. You're going to get errant wicks like that, but more or less the level holds. Now, but basically we're in a larger consolidation. Then price moves through, and then at one point it comes back, it retests. These little nuances are very, very important. Comes back and retests. Support becomes resistance before the dealers push price down. These types of patterns, as I get into them, when Trace was talking yesterday, all I kept thinking about is what I see here, what I see in this market. The spiraling down and spiraling up, and the different states and the adjustment in the states in the market. Maybe I can only understand certain aspects of what he's talking about, but in terms of conceptually, it felt like or sounded like what I see in the FX markets. But he was able to make more sense of it. Okay? So we see price moving down, basically trading in a range again. Then price slips through support. This is kind of an unusual move here, by the way, because the market, Europe and New York closed, and New York closed, but then Asia moved price further beyond out of the day's move, which is somewhat unusual. But anyway, it created a level of support. But then this dealing range became the level of resistance for the new dealing. So then price comes up here and it consolidates until on the next day Europe opens again. Then we start to see some volatility. Now there's two nuances here that are kind of beside the point but relevant. Number one nuance is this: Asia does not usually create new levels. They do not usually trade outside of the intraday range of the previous day's range. Here it did, create a level of support. Now, price consolidates, support becomes resistance, London opens. Nuance about the open of London and European markets. The market will often get pulled in one direction, fill, in this case, buy orders. It will often test the previous day's range, lower high. If it fails or if it holds, they're going to drive price the other way. Very, very common pattern in FX. London opens, the market starts to breathe, makes a run at the low, usually draws in people that are unaware of it, or they use capital of those who don't understand, and then order flow pulls down, generates liquidity, and then price gets pushed up. Okay? Now, let's look at it a little closer. Price gets pushed beyond this level. Then we have, so price moves through, then it trades for about an hour to an hour and a half in a range. Then it pushes through and trades for another hour to 2 hours in a range. Then it continues up, trades for another hour to 2 hours in a range. Resistance becomes support, resistance becomes support, resistance becomes support. So the dealing levels are constantly rolling over to the next level. Then price trades in a range. Then price comes all the way up to the previous day's support resistance level and struggles to get through and just consolidates from there. Or here on a larger level, price could come all the way back down here and then go up, but right now it's just consolidating into the next day. Now there's something that is very important to look at here, especially to adjust your mindset as a trader in terms of time, because time is one of the greatest challenges of any trader. The aspect or the concept of time and the movement of time and the submission to time as a trader. Submission to time can grind on you emotionally, right? Time can cause a huge spectrum of psychological changes from the time you start the trader, from the time that the market is at X price at X time to X price at X time, because we as human beings have difficulty, first of all, submitting to anything, okay, let alone time. to an unknown future of price and time. So let's look at this. Consolidates, moves through, consolidates, moves through, consolidates, price moves through, consolidate, moves through, consolidates, moves through. What percentage of time was price moving versus consolidating? Look. Okay? Yeah. 10, maybe 20%. Price is actually changing from one range to the next. Of course, we as traders want it to move 90%, the opposite, right? We want it to be 90% moving in our direction, and we want to have to wait very little because we're human beings. We like, fast food and quick service. So when we get into a trade, we want it to show us its nature quickly. Now, we have one candle and price moves quickly through and then consolidates, and then it moves through and consolidates. This is a 15-minute chart, so we see the same concept on all time frames. Whatever time frame it is you're trading. The market spends the majority of its time in consolidation and then moves out of consolidation in a smaller amount of time. Now we have ranges inside of ranges. So this whole range, this could be one range inside of a larger range. Or we look at it as sort of how would I call it? You could call them, fractals, like ranges or dealing states inside of dealing states on various time frames. Right. This single slide is going to be the root of how you would, if you're trading intraday in FX, that slide will assist you in understanding how you're going to work and manage your positions trading intraday. It also applies to longer term time frames, but of course you're going to be looking at longer time scale as well. Right? Does that make sense? So let me just take you now into the future again, so that you know where we're going with this. Let's say, for example, hypothetically speaking, we were to see that price came down, London opened, came down, we tested this low. It looks like it's going to hold. We don't know if it's going to hold. Looks like it's going to hold. Let's just watch and wait to see what price does. Well, you see this little dealing range? You see even this little one right here? We'd be able to see this quite clearly on a smaller time frame, like a 5-minute chart. What I would be doing as a trader, let's just say hypothetically we entered this position. We decided, okay, yes, it's going to hold. Well, how do we know it's going to hold? That's always the question. How do you know when to get in? We're dealing in this small range on a 5-minute chart because of, number one, here's what I would consider, number one, time of day. It's the open of London. Quite often, London will come down, test the previous day's level, and if it holds, then we're likely to see price move back into its overall larger consolidation. Okay? Now, I would watch this dealing range right here. If price starts to move up and hold up and trade above this dealing range, that's positive. Okay? Maybe I'll enter here, but you see this dealing range right here? We would get a bounce there, 5 pips, 10 pips. All I know is that the dealers are going to be watching this level. There will be some response to that level. So I would anticipate a bounce at this level. So here price comes up, it bounces at this level, comes down, retests this level here, and then starts to move up. I would also anticipate some market hesitation at this level. In this case, whatever the factor was, we don't know. Price moves right through. Now, if I was in this position and I entered this position at, let's say, 1970, let's say. Well, first of all, we got wood to chop. And I need to get to, let's say, at least 90 to make a profit. My first level that I'd need to battle is this level. Then I'd probably look at somewhere around here or here. Okay, you can see that. It's also the even figure. If you think about the dealers and the dealing desks, they like to use the even figures as reference points. Okay? So we'll watch the even figures. And what I would do is this, is if I was bullish here and price came up and moved above this level, the way I would be thinking is this. I'd say, okay, this trade, first of all, if I made a trade here, I'd have a stop with a large cushion allowing for a potential spike through and pull back. I'd give it room to breathe. Once it moves favorably, then I move my stop closer up because price seems to be, the market seems to be moving in a favorable direction. Then I would, if I'm sitting in front of my chart, staring at price, I'd say, all right, I need 1975 to hold. I need 19, so I'd be watching price saying, I need 1975 to hold. And as price accumulates this dealing range, then I'd say, well, we need to now move out of this dealing range and we need to get above, this level here. All the while understanding my previous levels of resistance and support, and of course Fibonacci levels and things like that. But I'd continue to watch it, and I'd say, okay, looks like we've got a level of resistance at 120. You maybe scale some of your position out. Move your stop accordingly, maybe leave some of it. I mean, this is a bit of another, we'll get into that later, but you can adjust your stop accordingly, scale some out accordingly, and so forth. But I'd be watching to see that each one of these levels holds. I would take the more significant ones and still expect that price could come up here and spike back to this one. If price starts moving down from here, I'd say, okay, now I need this level to hold for the next leg up. In this case, it's fairly steady, but we could still get other volatility in there. But when it comes to micromanaging a trade on an intraday basis, I'm mainly watching price, and I'm watching the dealer's deal price. And this is what I'm watching on the smaller time frames. All the while scrolling through charts, 15-minute, 1 hour, daily charts, especially if we have volatility, to look for changes in the nature of the market on the larger time scale, and to look for where more significant levels of support and resistance are. Okay.
What triggers you into the trade in the first place? I mean, obviously, we know when you're a support level, but what says to you, okay, I'm going to get in right here?
I know in advance, we're going to talk about range and so forth, but I'll know in advance where my key levels are that I'm eyeing. I'll know that in advance as the day starts. But trades can come in several ways. Number one, I can outline trading opportunities for that day in advance, but probably like 50% of my trades are trades that just come up throughout the day. It's a trade that will just, based on the way price moves, because we never know how it's going to move, based on the way price moved that day, all of a sudden the trade will present itself. And we'll get into that with some of the reversal and volatility patterns. Okay? So in this particular case, one of the first things I'd be looking for is the previous day's low. What this represents on a larger time scale, I don't know. This could be a significant Fibonacci level, a significant support resistance level, or an arm of a pattern. The base of a Gartley or something like that. Okay? So that which would cause me to eye that area. Okay? So very important. This slide is ultimately the root of how I'm going to be managing my position once I'm in. And I just want to show you how we see a similar characteristics obviously on all time frames. So here we have a 4-hour chart. I'm very much a trader that views the ranges as you'll see here. The market spends the majority of its time dealing in ranges as the market prices in the fundamental aspects of the overall market. And I like to trade in the range-bound parameters of the various time frames. Right? So we see here, for example, we're in a larger range. There's all kinds of, obviously, ranges within inside of these ranges. A lot of volatility that's tough to pick. I mean, if you're a market or momentum chaser, you can chase market price in one direction and easily get stopped out as the market changes direction. But you can see here how the market will simply respect levels of support and resistance all along the way. Here it deals in a range. This, for example, here price moves up significantly, attempts to move higher here, and then rejects quite quickly. It's a and that's all got to do with the flows. Price flows moving in one direction, weakness, changes in volume, as you know, and then price comes back. It's often a very bearish sign. Then we deal below this level of support, becomes resistance, and then we see continued decline in price. But again, we just see how the market is dealing in ranges, but within these larger ranges, we have smaller dealing ranges. Right? Here's a trending market where price is continuing to deal in ranges in the trending market. Right? Respecting levels of resistance and support all the way down. You see here we have a nice flow, and then we start to get choppy down here. That's reversal-like characteristics. So that's a 4-hour chart. Here's an hourly chart, again reflective of the market dealing in these price ranges. Okay. And we'll get into how specifically to find our trades as we move forward. Here's another 15-minute chart as we break it down from the higher we started. We had a daily chart example, and now we're breaking it down to the smaller time frames. Right? For example, you see this 15-minute chart. Price comes up here and makes a run at the high. That was event-driven. That's an event-driven scenario. Okay? And this is an indication of what kind of trade can result from an event-driven scenario. Those of you who were here 2 days ago, I talked about events where I don't stand in front of them closely before the event. Maybe several hours before the event I might engage in a trade, but too close to an event I won't. But let's say, for example, right now the market is floating in a bit of a no man's land, and we only have information here on a 15-minute chart. For example, price. This was a significant high here at the figure. The British pound, US dollar cross bounces at the figure all the time. Watch price, go back historically and have a look to see how price responds to the figure on the British pound. The reason why is because of knockout options and so forth, which I can get into the next couple days. But the event drives price above the figure here in this key high, but then it fails to hold. There's no trade there. I wouldn't chase that or anything like that. There's no trade there, not until this price level breaks down. Because if the event pushed higher and there was no follow-through and flows on the event, then we watch for price to break down. And this may just be a retracement in a larger overall downtrend, which would be more ideal. But I would watch for that level to either hold or to break down. If it holds and continues up, then in this particular case I would not be in the trade. But I'm usually looking for like the breakdown, which it does here. And then we see price continue to move down, trading on levels of. As price moves down, I would watch several levels. I would watch a level here, and I would watch this level, which it responds to, then this level, which it responds to, and this level, which it responds to. Okay? And then on a larger scale, this low becomes resistance, and you would be able to see that on the larger scale as well. The FX market does this all the time. It's just a part of its nature. The dealers, if you sit and stare at your screen 17, 20 hours a day, you will see this all the time. Whether or not there's trading opportunities is another story, and where to find your specific trading opportunities is another story, but it's important to understand the foundation of this first, because it's going to be the root of your position management and also determining the probability around trade scenarios and where you can expect the market to stall and so forth. But again, what percentage of the time is the market moving versus consolidating? Okay?